The only things that have added to your actual wealth, i.e. your ability to buy more in the future of other assets or whatever, is technology and crypto.
Hey guys, welcome back to Library of Wealth. Macro investor and CEO of Vision Raoul Pal shares his prediction for the crypto market and the economic shift coming in 2023. The respected former Goldman Sachs executive gives a captivating forecast for the cryptocurrency market, which he acknowledges is creating a stir in the financial world. According to Pal, a bullish phase is on the horizon, with Bitcoin at the helm, marking the dawn of what he calls the exponential age. He says we're on the cusp of a significant bull run for digital assets in a time of swift and substantial technological advancements. Pal predicts technology stocks will overshadow other types of investments, but cryptocurrencies, particularly Bitcoin, are poised to take center stage. He says a new bull market cycle commenced in October of last year, and although this cycle may witness periodic corrections, he foresees the crypto market reaching new highs in the coming months. Let's get right into the latest interview as Raoul Pal gives his latest prediction for how the financial world is on the threshold of an exciting evolution. Don't forget to hit the like button and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
It's difficult to put it all into one place, but essentially the world that we knew is broken. It's broken because of demographics. So if you think of, I call it the magic formula. What is GDP growth? GDP growth is basically population growth plus productivity growth plus probably debt growth. And debt growth kind of robs the future to create current growth. And when you look at those three factors, most of the Western world plus China are seeing shrinking populations. The US is kind of flattening, not shrinking, which is why the US trend rate of GDP growth is somewhat higher than Europe and Japan, and China's still a bit different because of the stimulus packages. Then we look at productivity growth, and it's been declining for a very long time now. And so we have a decline in productivity, either declining population or slowdown of population growth, and debt growth reached its limit in 2008. And this is the key part. So really what GDP growth does is finance investment and also debt payments. When a government gets to 100% of GDP in debt, which the EU, Japan, US did, and UK's just done so last week, if they're 100% in debt and the trend rate of GDP is, let's say, 2%, to make easy maths, and interest rates are at 2%, 100% of GDP growth goes to paying interest. Because every year you've got to pay the interest, it needs to come out of GDP. So that means the economies wouldn't grow. Now, it used to be covered up by debt growth, but what happens now is that the private sector is over 100% of GDP in debt as well. So you're competing for the GDP to service the debt payments. And the answer ended up being, in 2008, is we will just put it on the balance sheet of the central bank. And the Everything Code, part of the Everything Code, which is a very big, broad thesis, proves, as much as I can, that all interest payments are just the monetization of the debt from about 3.5 years ago. Why 3.5 years ago? It's this 3 to 5 year window. The economy has come very cyclical because in 2008, we actually got the great reset that people have been waiting for. The reset was saying, okay, interest rates don't count anymore, they're all going to zero. So everybody can service their debt. Right? People haven't framed it in these terms, but that's what it was. And then everybody refied their debt. And governments have generally, and corporations generally have refied in the 3 to 5 year sector. So you get this 3.5 year cyclicality of the economy that debt payments come due, the economy slows down, rates get cut, and we keep going through the same cycle over and over and over again. This one got somewhat skewed by COVID and what it did to supply. So it created a larger inflationary shock, but generally the framework is still there, that the central banks need to monetize the interest payments or the economy compounds negative forever. That's a big thing to get your heads around. And I've proven that the US has done it, Europe's done it, Japan has done it, and the UK have done it. I think there is a global central bank agreement that they need to keep interest rates down below trend rate of GDP growth when it comes to rolling these payments. That is the key part. And those interest payments are what's driving up the central bank balance sheets. The central bank balance sheets are liquidity, and we'll talk a bit about the liquidity element later, but what they actually are is debasement of currency. You're basically borrowing money to pay off the interest on the other money, and that's a pure debasement of currency. And that optically makes assets go up in price. Optically, because it's actually the denominator that's falling and not the asset prices. So with part of the everything code, I changed the denominator for all assets to the global central bank balance sheets and found out that most markets have gone nowhere once you look at it in those terms. They all look more like Europe did, which was a sideways ranging market. And that was the S&P went nowhere, real estate went nowhere, gold went nowhere. But there were two that did, which was technology and crypto. And I'm like, what's that all about? And that was this realization that got me to the exponential age, which preceded this whole thesis, that those are not only driven by the debasement, but they outperform because they're driven about technological adoption. So they're driven by Metcalfe's law and other factors. So what I then found out is when we built a liquidity formula for GMI, myself and Julian Bittel, and we found that according to our measures of liquidity, the NASDAQ, the S&P, all of these things, let's use the NASDAQ, 97% correlated with liquidity, particularly the central bank balance sheet, because it's the denominator. And we can then forecast into the future by using a lot of the work that we do in GMI, where liquidity is going to go. We also know what the central banks are going to do because they monetize their debt 3.5 years later. So we can actually build out models into the future where we think liquidity goes. And if assets are 97% correlated, we can forecast assets out into the future as well, which is what makes it an everything code. It's a hypothesis, a thesis, needs to be tested. It's very bullish on assets going forwards because we're in the point in the cycle where economic growth is falling, inflation is falling, unemployment will start rising. And at that point, you tend to get stimulus over time. And we've seen the central bank balance sheets. The Fed used theirs for the banks. We saw Japan with the yield curve control, the UK bailing out its pension system. So bit by bit, we're starting to see the return of the debasement. And over time, it should accelerate at this point in the cycle. And that gives us a very good backdrop to assets, particularly crypto, which is the fastest horse in the race.
Pal points out that interest payments drive up central bank balance sheets, which translates to liquidity. He argues this process leads to a debasement of currency, where money is borrowed to pay off existing debt. He believes that this debasement optically inflates asset prices, while in reality, it is the falling value of the currency that drives this perception. Pal doubles down on the concept of the everything code and explains how he changed the denominator for asset prices to global central bank balance sheets. Pal maintains a bullish outlook on assets, particularly cryptocurrencies, which is supported by the current phase of the economic cycle, characterized by falling growth, inflation, and rising unemployment. He points out that assets like technology and crypto have the potential to add to the wealth and increase future purchasing power, which is crucial heading into the last part of the year. What do you think about Raoul Pal's latest prediction for the crypto market and how the financial world is about to enter into the exponential age? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.